Here's a summary of Coca-Cola's KO Q2 2026 earnings call, designed for clear and concise delivery. Introduction. Good morning, everyone. We've just concluded the Coca-Cola Company's second quarter 2026 earnings results conference call. I'm here to walk you through the key takeaways from the discussion led by CEO Henrique Braun and CFO John Murphy. Overall performance and key financial metrics. Coca-Cola delivered a strong second quarter and first half of 2026, demonstrating broad-based momentum across its business. The company grew volume by 5% for the quarter, aided by an easier prior year comparison. On a two-year average, volume grew 2%, indicating a more balanced contribution to top-line growth. Organic revenue grew at the high end of their long-term growth algorithm, specifically 6% for the quarter. This performance was driven by a 2% price/mix, comprised of 3% pricing actions partially offset by 1% unfavorable mix, primarily due to investment timing. Profitability also saw significant improvement. Comparable gross margin increased approximately 120 basis points, and comparable operating margin increased approximately 90 basis points, driven by underlying expansion and currency tailwinds. Comparable earnings per share, EPS, reached 97 cents, an increase of 11% for the quarter, including a 2% benefit from currency tailwinds. For the full year, the company now expects comparable currency-neutral EPS growth of 7% to 8%, excluding acquisitions and divestitures, and overall comparable EPS growth of 9% to 10% versus 2025's $3. Free cash flow was robust, totaling approximately $6.9 billion, an increase versus the prior year, with a strong balance sheet characterized by a net debt leverage of 1.4x EBITDA. Management's forecasts and outlook. Looking ahead, Coca-Cola has raised its full-year guidance. They now expect organic revenue growth of approximately 5% at the high end of prior guidance, despite 6 fewer selling days in the fourth quarter. Comparable currency-neutral EPS growth is now projected at 7% to 8%, and overall comparable EPS growth is expected to be 9% to 10%. Divestitures are anticipated to be a 2% to 3% headwind to net revenues and a 1% headwind to EPS. The company anticipates an approximate 1% currency tailwind to net revenues and a 3% tailwind to EPS for the full year. The underlying effective tax rate remains at 19.9%. Significant risk factors. Management acknowledged the uneven global consumer environment, characterized by inflationary pressures, geopolitical uncertainty, and economic challenges. Specific mentions included cautious sentiment and selective spending in China, and mixed sentiment in Latin America. Commodity volatility continues to be monitored, though the overall impact is believed to be manageable. The company also highlighted the pending sale of Coca-Cola Beverage Africa, which, if closed in late Q3 or Q4, will represent a headwind. A notable ongoing dispute with the U.S. Internal Revenue Service regarding tax matters was discussed, with the company remaining confident in its position and awaiting a court decision. Highlights. Strong volume growth of 5% for the quarter, the strongest in 17 years for trademark Coca-Cola, excluding COVID recovery. This was significantly boosted by the FIFA World Cup integrated marketing campaign, which drove engagement, data collection, and commercial impact, with an average beverage incidence of over 80% at venues. The company reported gains in both value and volume share across many markets. The strength of their total beverage portfolio and the power of their global, yet local, system were cited as key advantages. Fairlife production operations have largely resumed, with minimal impact anticipated for the second half of the year. The Marriott contract win after 34 years was highlighted as a testament to their enhanced consumer and customer-centric approach. Margin expansion was a significant achievement, with management confident in their ability to continue driving underlying margin improvement through quality top-line growth and cost management. Lowlights. While growth was strong, the consumer environment remains uneven, requiring strategic RGM, revenue growth management, to balance affordability and premiumization. In EMEA, profit declined due to the phasing of investment, despite revenue growth. In Asia Pacific, comparable operating income declined due to investments aimed at expanding the consumer base, particularly in China and India, where the company is investing ahead of the curve to build long-term growth. This included some value share losses in India. The timing of concentrate shipments lagging unit case volume was noted for the third quarter and is expected for the full year. Most important statements from the CEO and CFO, CEO Henrique Braun. Our results reinforce our three beliefs. We operate in a great industry, our beverages are well loved by consumers, and the strength of our system is unmatched. We delivered a strong quarter with broad-based momentum across our business. We also expanded margins while continuing to invest in our business, delivered double-digit earnings growth, and gained value share. Across much of the world, we see an uneven consumer environment. They are evaluating how they shop, what they value, and what they want to put in their basket. The FIFA World Cup integrated marketing campaign showed the power of our system at scale and drove momentum across our business. Our priorities are helping us to create a stronger system today while building the foundation for our next chapter. CFO John Murphy. Our second quarter and first half results demonstrate the strength and consistency of our business model. Comparable gross margin increased approximately 120 basis points, and comparable operating margin increased approximately 90 basis points. Both were driven by underlying expansion and currency tailwinds. Given the momentum of our business and the strength of our balance sheet, we have increased flexibility and optionality to continue to both reinvest in our business and return capital to shareowners. Based on our year-to-date results and expectations for the balance of the year, we expect to deliver at the high end of our prior revenue guidance, with organic revenue growth of approximately 5%. We continue to have confidence that we will ultimately prevail in the IRS tax case. Conclusion. In summary, Coca-Cola is pleased with its strong first-half performance, which demonstrates the effectiveness of its strategy and the advantages of its global system. The company is focused on staying close to consumers and customers to create durable top-line growth and long-term value, and remains confident in its ability to deliver its updated 2026 guidance and longer-term financial objectives.